If you want to grow your business this year, but you're worried that growth is going to drain your profit and your cash, this episode, it's for you. Because what usually goes wrong, it's not our ambition. We're visionaries. We got the motivation and ambition. It's that growth, it happens without a clear plan about where money is supposed to go. Growth is not the problem. Growing without a framework is. Welcome back to Business by the Books. I'm Danielle Hayden, CEO of Kickstart Accounting. The last two episodes laid the groundwork for today. First, we talked about the one number every business owner needs to know at all times: net profit. Because without profit, your business, it cannot support you, absorb slow seasons, or fund what's next. Then we talked about the difference between bookkeeping and CFO level thinking. Bookkeeping tells you what already happened backwards. CFO thinking, planning, and support helps you decide where the business is going in the future. And today is where those two conversations come together, because knowing your profit, it's important, but using it to plan growth is what actually changes how your business feels for you as a CEO. This is the exact framework we use in our CFO services to help business owners grow without losing money. So what is the framework and how can we apply this at any level? Let's break this down. We have 3 buckets of spending in our business, and I'm going to walk you through the buckets and then how to apply it. The first bucket is our operating expenses. And in this framework, I want 65% of our revenue going to operating expenses. So when we think about how do I have enough space for cash and profit in my business to stay profitable, but invest in growth, we need to look at our expenses and adjust so that our current operating expenses are 65% of our average monthly revenue. So this bucket, this is what it takes to run the business today without any growth. Payroll, contractors, software, your rent, facility, insurance. This is everything that keeps the doors open to your business without any new growth. This is the operating expenses that we want to fund our current revenue. So when operating expenses consistently exceed that 65%, our next bucket is savings. This is an anchor. We want to have 20% of our sales that we can put aside for savings. This 20% is going to allow your business to breathe. It gives you the cash reserves. It funds paying taxes without panic. And it allows you to pay yourself draws as your business grows and you have leftover funds. It gives you options. If this bucket is underfunded, then growth will always feel risky, no matter how much revenue is coming in. If this bucket is significantly overfunded, it may be a signal that you're under-investing in your growth. So we want to have 20% of your average monthly revenue moving to savings to fund your cash reserves and your taxes. This is going to give you options for the future. So bucket 1, operating expenses, that is 65% of your sales. Bucket 2 is 20% for your savings. Bucket 3 is 15% to growth. This is where growth becomes intentional instead of emotional. Additional marketing, hiring ahead of capacity, systems, infrastructure, strategic support. This bucket exists so growth doesn't rely on your stress, credit cards, or personal cash. If growth spending fits inside this 15%, you can move forward with confidence. If it does not, the answer is let's pause. Let's pause to ask what needs to change first. Pricing, timing, structure, spending. Growth should be funded by the business, not forced by the owner with debt and owner's contributions. So how do we apply this framework to your financials right now? You guys know I like action, so we're gonna go take action right now together. You're gonna start with your most recent income statement. Now remember, we cannot use our income statement with incorrect bookkeeping. Our bookkeeping has to be correct in order for us to use these tools. So once you know that your bookkeeping is accurate and reconciled, you can take your most recent income statement. And I want you to use your actual revenue, not your goal revenue here. You're going to take your average monthly revenue for the last 12 months. Kickstart Accounting Inc. clients, you receive that number in your snapshot every single month. So take your rolling 12-month revenue, and you're going to calculate your 3 target number. The first target number, you're going to multiply your average monthly revenue by 65%. This will give you your operating expenses. Next, you'll take that average monthly revenue and multiply it by 20%. This is the cash that you need to have reserved for savings. Then we'll take our average monthly revenue and multiply that by 15%. This is your growth fund. Now, I want you to compare those targets to reality. We're going to compare what we spent last month or the last 3 months to what the target is today. I want you to really look. Are your general operating expense to just fund the day-to-day of your business exceeding 65%? Maybe it's exceeding 80% of your business, 90%. This is why we have a hard time as business owners funding future growth and spending in marketing and advertising. We're spending our revenue on just operating the business. Do you have enough cash in your savings to pay the tax bill that we all know is coming? And is there intentional spending in your financials for growth? I want you to take your income statement for last month. I want you to label each account as either operating expense or a growth fund. So maybe this month you did run a paid advertising campaign. Maybe you hired a new team member who's not at capacity, but they will be. Those are initiatives for the future. Those are what we consider investments in growth. At the end, I want you to total those dollars up and compare it to your buckets. How are your actual month-to-month expenses comparing to the 65%? How is your growth spending today compared to the 15% we have allocated here? Compare your actual spending today to the buckets that we have created. I want you to be able to take your current revenue that you have today in the business to be able to fund the growth. What happens if we are not able to fund growth with our current revenue? In next week's episode, we're going to walk through the specific changes that you can make to increase revenue and profit. Guys, this is where CEO level leadership, this is where it shows up right here in this moment.